Silicon Valley Bank, SVB, one of the largest banks in the United States, has collapsed. It is the largest bank to fail since the financial crisis of 2008, and was providing banking services to nearly half of all U.S. technology companies and over 2,500 venture capital firms. Many factors contributed to the bank's collapse, but in essence, rumors that the bank was in trouble generated mistrust among its clients. Many of these clients were owners of startups and companies that could not afford to not pay their employees in the coming months, so even if there was only a small possibility of collapse, they decided to withdraw their money. To cope with the withdrawals, the bank decided to sell assets and shares. The assets were sold at a loss, and by selling so many shares at once, it caused the bank's stock price to plummet. As you can imagine, this provoked even more cash withdrawals, which ultimately left the institution without liquidity and facing bankruptcy. Finally, the Federal Deposit Insurance Corporation, FDIC, announced that it would take over the institution since no buyer was found who wanted to intervene. And, as a result, they have guaranteed that each customer will receive up to $250,000 per FDIC account, but they will have to wait for the sale of SVB's remaining assets to see if they can recover more money. The collapse of Silicon Valley Bank, SVB, is a shocking and concerning news for the world of technology and finance in the United States. The collapse of SVB is a reminder that no financial institution is exempt from risks and that, in the business world, trust is a very valuable currency. SVB was considered the benchmark bank for technology and venture capital companies. The institution had managed to build a solid reputation as the bank that understands the business of innovation and creativity. With an enviable client portfolio, SVB became synonymous with success in Silicon Valley. However, its collapse has shown that even giants can fall. The collapse of SVB is the result of a series of factors including poor internal management, increased competition, and rumors about its financial situation. Rumors that SVB was in trouble began to circulate in the summer of 2022, and although the bank's management denied it outright, clients began to withdraw their money. The withdrawal of clients' funds triggered a chain of events that led to the bank's collapse. To cope with the withdrawals, SVB decided to sell assets and shares. Unfortunately, the assets were sold at a loss, and the massive sale of shares caused the bank's stock price to fall. The fall in the stock price triggered an even greater withdrawal of cash, leaving the institution without liquidity and on the brink of bankruptcy. The Federal Deposit Insurance Corporation, FDIC, took over the institution when no interested buyer was found to intervene. The FDIC has promised that each customer will receive up to $250,000 per account, but it is still unclear how much money SVB's clients will be able to recover. The collapse of SVB has left many technology and venture capital companies in a precarious position. Many of these companies relied on SVB as their primary provider of banking services, and will now have to seek alternatives. In addition, the collapse of SVB has shaken investors' confidence in the technology sector, which could have a negative impact in the future. Although the collapse of SVB is a regrettable fact, it is also a lesson for investors and entrepreneurs. Trust is a valuable asset in the business world, and when it is lost, it can be difficult to regain. Moreover, it is important to note that no financial institution is exempt from risks, and it is the responsibility of clients and investors to be vigilant and attentive to any warning signs. One of the key lessons we can learn from the collapse of SVB is the importance of diversifying our investments and banking services. While SVB was considered a benchmark bank for technology and venture capital companies, its collapse has shown that even the largest and most respected banks can fail. Therefore, it is important for companies to diversify their banking services and consider working with multiple banks to reduce risk. Additionally, it is important for investors and entrepreneurs to be attentive to warning signs in the financial sector. The rumors about SVB's financial situation were a warning sign that many clients ignored. While it is important not to panic in the face of rumors, it is also important to investigate and understand the financial situation of any financial institution in which one is considering investing or doing business. Another key lesson we can learn from the collapse of SVB is the importance of maintaining healthy financial management in our businesses. Companies that rely on venture capital often depend on a constant injection of funds to stay afloat. However, this can also make companies more vulnerable to market instability. Therefore, it is important for companies to maintain healthy financial management, which includes cost-cutting and establishing an emergency fund. In conclusion, the collapse of Silicon Valley Bank is a regrettable fact that has shaken the confidence of clients and investors in the technology and finance sector. However, it is also an important lesson for investors and entrepreneurs. Diversification of banking services, attention to warning signs in the financial sector, and healthy financial management are key measures we can take to protect our businesses and investments.